bags. In this video, we are going to address how to properly account for purchasing inventory under the perpetual system. So by the end of this video, you'll be able to properly account for purchasing your inventory correctly. But first, I think the easiest way to approach this would be to explain the merchandising operating cycle of the company. So basically with a merchandising company, they chase the bags by selling inventory. So the company has to use its already received cash to purchase the inventory first from the supplier and then sell it to its customers. Now, when the company sells the inventory to its customers, either two things are going to occur as they generate the revenues. Either they're going to directly receive the cash simultaneously, or they're going to sell that product on account. If they sell that product on account, then the next step is to collect on that account. And we know that the sooner we get the cash on account, the better it is for us to be able to what, gang? Buy more inventory. So that's the process. We keep purchasing inventory, selling the inventory for a profit, and then using the proceeds from that to purchase more inventory, therefore increasing our revenue stream. And so with that being said, I am going to break down each aspect of that particular purchasing process, starting with purchasing the inventory. So we're not going to reinvent the wheel, gang. You guys have been recording purchases of inventory almost from day one. But I'm going to let you in on a little secret. Most of the time, companies purchase their inventory from suppliers on account. Why? Because they can use their cash for other purposes like operating a business, paying off certain expenses or whatnot. So just the fact that they could defer using the cash just a month maybe, interest-free, would definitely entice most companies to do so. Remember, $1 today is worth more than $1 tomorrow, and companies always keep that in mind when making their cash decisions. So let's look at an example of purchasing on the account. Okay, gang. On April 1st, suppose that It's a Joke purchases inventory on account times 210, net 30 for $10,000. So first and foremost, when we're dealing with merchandising inventory, I like for you guys to make sure you understand clearly which side of the transaction you are on in regards to being either the purchaser or the seller of inventory. And as always, before we record transactions, we identify the keywords. So our first keyword is obviously purchasing inventory on account. Now, these discount terms are simply stating that we will receive a 2% discount if we pay within 10 days of April 1st, or we have to pay the remaining amount or the entire amount within 30 days of April 1st. So regardless of what amount that we pay, as long as it's within 10 days of today, we will receive a 2% discount. And so with that being said, we already know we're on the purchasing side, and we're just simply recording a transaction of purchasing inventory. So what are we going to do? As always, gang, we're going to debit inventory and credit accounts payable for the $10,000. And that's that. So now that we properly recorded the purchase of inventory, let's discuss the purchase discount. So basically, purchase discounts are offered to the buyer anytime that they purchase a particular good on account. So from the seller's perspective, they want to receive their cash as quick as possible because it's slowing down their cash stream. And so what sellers will do is try their hardest to entice the buyer to pay back as quick as possible. And so what do? They offer discounts. Now, basically the discount is as such. If you pay within a certain amount of a time frame, then you're going to receive a certain percentage off on the particular payment. For example, a 210 net 30 discount term simply means that the buyer is going to receive a 2% discount if they pay any amount owed within 10 days from the initial sale, or they have to pay the remaining amount by 30 days. So any amount, it could be $1. If it's paid within 10 days of the initial sale, they will receive a 2% discount. And so one thing I want you guys to remember when dealing with inventory on the purchasing side, put it in your brain, tattoo it up there.
What about mine? Dude, what does mine say? Sweet! What about mine? Dude, what does mine say? Sweet!
Inventory is always on the books at cost. Always on the books at cost, inventory must stay or remain. So how does that affect us with the purchasing of a discount? Anytime that we as a buyer of inventory receives a discount on the purchasing side, it reduces the cost of inventory. Therefore, we should reduce or credit inventory. Let's take a look at an example of paying on an account during the discount terms. Okay, gang, it is now April 4th, and suppose that It's a Joke paid $2,000 on account. And so first and foremost, we need to identify the keywords so that we can properly understand whether we're on the purchasing side or selling side. And so we have paid as a keyword and on account. Now, this is a continuation from the April 1st transaction, which we purchased some inventory. Now we're paying $2,000 on account for that inventory. And so with that being said, that particular purchase on April 1st came with a discount term of $210 net 30. And so that basically means we're going to get a 2% discount if we pay within 10 days from April 1st, or we have to pay the remaining amount or the full amount in 30 days of April 1st. And so this payment is going on the 4th. So you have to pay attention to the dates when dealing with inventory. And so this basically means that we are in the discount term. So how are we going to record this payment on the account? Well, obviously, we know when we pay on the account, the liability accounts payable goes down. So we're going to debit accounts payable. And of course, we're going to also credit cash. Anytime you see the word paid, you know to credit cash, right? But we're in the discount terms. So what does that mean? Well, let's identify one key fact. Since we paid within the discount terms, we are actually not paying $2,000. We're going to receive a 2% discount on the $2,000. So our cash amount will actually be the combination of $2,000 times 0.98, gang. Now, why did I do 0.98? Because 100% of $2,000 will actually be the full $2,000. But we're not paying 100% of the $2,000. Why? Because we are receiving a 2% discount, which in all actuality means that we're paying 98% of the $2,000. So if we multiply 98% of the $2,000, that'll give us the full amount in which we owe. So if we take 0.98 and multiply it times $2,000, that will give us $1,960. Now, the accounts payable was initially recorded at the full amount. No discounts was extended. We recorded it on the first gang at the full amount. Therefore, accounts payable must be reduced at the full original amount. So that means we're going to take $2,000 from accounts payable. As you can see, our debits and credits don't equal yet because we're not finished. We have one more account that must be satisfied. And remember what I told you guys, gang. Inventory is always on the books at cost. And anytime that you receive a discount, the company receives a discount, that's going to reduce the cost of inventory, which basically means we have to reduce inventory. Therefore, we're going to credit inventory for the discounted amount, which happens to be the difference of the 2000 and the 1960. And I believe that's 40 bucks. And we are done. Now that we have properly identified how to pay on an account within discount terms, let's identify how to properly record a purchase return or allowance. So on the purchasing side, we know as customers, the company can actually return the goods back to the supplier. If the company returns the goods back to the supplier, we must always understand that inventory is recorded on the books at cost, and we are dealing with the purchasing of inventory. Thus, if we simply return our inventory to the supplier, we have to reduce the cost of inventory, which means we're going to credit inventory. So what about an allowance? Well, on the purchaser side, an allowance is accounted for exactly the same way as a purchase return. But there's a big major difference. An allowance is when the seller reduces the amount that's owed to them from the buyer. For example, suppose I sold you guys a pair of shoes and the heels fell off. So you called and complained and moaned and everything else, and you wanted to return the goods. But I didn't want the goods because I know they're crap too.
Oh, this sucks.
So instead of you returning the goods to me, I just said, hey, I'm going to give you an allowance of $100. Basically meaning I'm going to lower the amount that you owe me by $100. So how does that affect the books? Exactly the same way as a purchase return. Why? Because whenever we as buyers receive an allowance from the seller, the cost of inventory has gone down. Thus, we need to lower our inventory on the books. Let's take a look at an example of a purchase return and an allowance. Okay, moving on. April 7th. Suppose that It's a Joke returned $1,000 worth of inventory. Again, we're going to identify the keywords. And we have returned, and we have inventory. So again, we are on the purchasing side in continuation from the previous transaction. So this is an example of a purchase return. We returned the inventory. Now, whenever we have a purchase return, it reduces the cost of inventory, which means that our inventory must go down. Why? Because inventory is always on the books at cost, gang. And what else is going to go down since we made this actual return? We bought it originally on the first on account, which means that our liability must go down as well. So we're going to debit accounts payable, and we're going to credit inventory because it's a purchase return. What about on the 10th? What happened on April 10th? It says, suppose It's a Joke received a $500 allowance. So keywords, received, and an allowance, right? And so what do we know about allowances? Unlike returns, allowances, the purchaser gets to keep the actual goods, right? We know when we make a return, a purchase return, we literally return the physical goods back to the seller. But when we are given an allowance, it still reduces the cost of inventory. Even though we still have the goods physically, our cost of inventory has been reduced. So, again, just like a return, we will make the same transaction. We will reduce our accounts payable as well as reduce the cost of our inventory. We're going to credit inventory, gang, for the $500. As long as you remember inventory is on the books at cost, you will be A-okay with this transaction. And so lastly, instead of recording how to properly pay within a discount term, let's identify what would happen if we would pay outside of the discount term. Well, it's pretty simple, gang. Anytime you pay outside of the discount term, you don't receive the discount. So you would just record it like a normal payment on an account. Let's take a look. Okay, last but not least, April 15th, suppose that It's a Joke paid on the account in full. So obviously, gang, we are deciding to pay on an account. So first and foremost, we already know we're on the purchasing side, and we need to identify the keywords. So we have paid, on the account, in full. But what we also need to mention is the date. Why is the date so important? Because initially on the first, we had discount terms that was given to us. And if my memory served me correct, the discount terms was 210 net 30, which means that basically we were to receive a 2% discount if we paid within 10 days of the initial transaction, which happens to be on the first. It is now the 15th, gang. And so since we're paying on this account the remaining balance owed, there's no discount available for us. So what we're going to do is just record this as a normal payment on our account. But we still have to identify how much is owed. So what account should we analyze? Accounts payable. So if we look at our accounts payable account, we remember on the first, we had a purchase of $10,000. Then on the fourth, we had a payment of $2,000. On the 7th, we had a return of $1,000. And lastly, we received an allowance on the 10th for $500. So the remaining amount owed is a total of $6,500. And so we're going to normally record this transaction like a payment on our account. So we're going to debit accounts payable for the $6,500, and we're going to credit cash for the $6,500 as well. So that wraps up how to properly address purchasing inventory under the perpetual system. Hopefully you guys were able to connect the dots with the help of this video. And if so, don't forget to like, subscribe, and share the channel with your friends for more ways to chase the bag game. As always, it's been a pleasure. See you soon. Bags!